Good morning, everyone. Good morning. I am R.Colson, CEO at IPEM, the leading conference in European private markets. And we are very happy to support the organization of today's virtual event, and especially the Dorio Awards that are rewarding the best academic papers in the field of private equity. Private equity is a fast and constant changing market, and fund managers and institutional investors alike are increasingly sophisticated. So that's a great thing to see that research keeps up the pace. The secondary market epitomizes this phenomenon, this increased sophistication. Secondary transactions grew from about $40 billion in 2015 to almost $90 billion in 2019. In 2020, GP-led transactions boomed, and many LPs also have now integrated secondaries in their playbook. The market has a lot of room to grow. Secondary trades, from the data I got, only represent about 1% of private markets AUM, or about 3% of NAV every year. So we will discuss the latest trends in these exciting markets with our three great panelists today. And let me start perhaps by introducing each of you, and start with David, because you were the one that woke up the earlier today. So good morning, David.
Good morning.
David, so you're head of private equity at the New York City Retirement System, which is one of the largest public pension plan in the US, with 200 billion under management, of which private equity represents about 13 billion, sorry, if my data is correct. And on Prekin, it's mentioned that you have about 130 fund managers in your portfolio, so a rather large scope of fund managers relationship. So you really deserve our thanks, because it's quite early in New York. Sure. I hope you had time to grab a coffee. So good morning, and thank you for being here, David.
Thank you. Good morning.
Bernard Engelien. Good morning, Bernard.
Good morning, everyone.
So you're co-heading Greenhill & Co. Capital Advisory Group here in Europe, working with LPs and GPs on their secondary transactions. A figure I found is that in 2019, Greenhill advised about 17 billion in secondaries disposals. So a very interesting point of view that we will bring to this discussion. And on the buy side, we have Richard R.Wilmes from München, managing director and head of the secondaries at Golding Capital Partners. Golding manages about 10 billion for institutional investors, and is primarily involved in managing fund of funds. But you, Richard, leverage on the firm's numerous GP relationship and expertise to launch the secondary business and to raise a secondary fund in 2019. Good morning, Richard.
Morning.
Perhaps as a start today, because we are all now speaking remotely, it could be great to get your comments about the last few months. These have been extraordinary times, and I was wondering how the situation had an impact on the secondary market and on your respective activities. I think, Bernard, you can probably start with this one.
Sure. So look, it's certainly been an interesting year for us and the other market participants. I think what we saw last year is that activity started at a relatively high level back in January. Then the COVID crisis accelerated end of February, early March. A lockdown came. I think there was obviously a lot of volatility also in public markets, and I would say a sentiment of a wide sentiment of uncertainty around what would be happening. That included GPs, not really knowing how their portfolios would perform. in this new COVID environment, and also I think institutional investors, including also secondary buyers, posing to see how both companies would perform, and also how the broader macro environment would evolve. I think what we then saw is that the second quarter was very quiet. I mean, we closed a few transactions, including some large ones, but I think the majority of the transactions were put on hold, both on the I would say on the GP-led side, but also on the more traditional part of the market. What we then saw is that as public markets recovered relatively quickly, if we compare to what happened during the great financial crisis 10 years ago. So markets bounced back very quickly. I think as the June NAVs were published during the summer, people started to see that actually the bulk of portfolio companies were actually performing reasonably well. Obviously, some sectors like travel, hospitality, energy sectors, high street retail were affected more severely. But I would say overall the economy continued to perform reasonably well, and so I think that contributed to confidence returning, and we really saw that the market activity bounced back significantly. I would say starting in August and then September, and then the last quarter of the year was very busy. I think in terms of mix, we certainly saw a lot of GP-led activity. And a large part of that was actually concentrated in the US more than Europe and Asia. I think on the traditional side, we saw some transactions coming back to market, from September onwards. But I think generally there was much more of a wait and see attitude. I think a lot of institutional investors, such as David and others, they had no pressure really to act. I think distributions actually remained pretty strong despite the crisis, and many large LPs I talked to tell me 2020 was one of the best years they've had in terms of liquidity. So there was no real pressure from a liquidity perspective. There was no pressure from a denominator effect perspective, and so I think a lot of LPs said, well, yes, maybe I would like to make some adjustments to my portfolio, but there is no rush. And so what we've seen now is that actually the LP side or LP portfolio side of the market is coming back quite strongly. And we have seen several large transactions coming to market in the first quarter, and that's continuing in the second quarter. So I think what we would see this year is that the significant drop we saw in terms of LP portfolio supply will basically rebound this year, and we think that the GP-led side will remain very active. I think, yes, last year was a record year in terms of the share of the GP-led market, which was nearly 50% of the overall market activity. But if you look at the absolute amounts, I mean, the 26 billion from 2020 were actually the same as in 2019. So in absolute terms, the level of transactions which closed on the GP-led side was about the same. I think the key challenge there is really one, capacity of buyers to diligence opportunities, because there's only so many people around who can diligence an opportunity at any point in time. And then there is also a shortage of capital, because most secondary funds will have a concentration limit anywhere between 2 and 4% to any given company in their fund. And that means that when you have a GP-led, going into the hundreds or even, in the billion-dollar territory, that obviously makes it tricky for a single buyer to do the entire deal. So I think what we'll see this year is that there are a number of new entrants coming to the markets. We see Apollo, we see TPG and others. There have been rumors around CVC wanting to enter also the secondary market. So I think we see a lot of the traditional, multi-product large GPs, entering the space. And so I think that's a good thing. It will increase the pool of capital and hence contribute to growth. So I think we are very optimistic for this year. I think overall volume will bounce back to probably 90+ billion. Mm-hmm. But I will let my fellow panelists comment also.
We'll discuss some of the trends you mentioned. David, from an institutional point of view, how have been the last few months, and especially if you take this, secondary angle? Do you think it was since the market was quite calm on this side? Can you comment on that?
Yeah, I think I'll give you the LP perspective, primarily from a receiving end of liquidity options. I think my observation was in 2020, probably starting in May and June, my team and I were a 6-person private equity team. We were getting fairly frequent inbound calls from our existing GPs, at a range of stages. Some were, look, we want to give you a heads up. We've engaged an advisor to explore a potential GP-led. We want you to hear it from us directly. We'll keep you posted. Others were, we're launching and you're going to get deal documents in a couple of weeks. And then, some relationships were, hey, we've got this asset. We're thinking about trying to sell it, but the M&A market and the uncertainty around it, because of COVID, makes it challenging. We're thinking about doing one of these GP-led deals. Like, how do you react to that? Do you think it's a good idea? Almost asking us as LPs, kind of for strategic advice. And that was the pattern, I think, for us between May and the end up to today. And we were just receiving a number of liquidity options. I think what's really interesting about what Bernard said was that the absolute volume of GP-leds was fairly consistent. And I think he's right. It was really the relative change because the LP-led deals really dropped off a cliff in 2020. But my experience at New York City, where, as Antoine, as you mentioned accurately, we have over 100 GP relationships. So we see, a good slice of what's happening in the market, is that the quality of the GPs accessing the GP-led secondaries market has materially increased, right? And I don't think, one thing, it really grabbed the headlines in 2020 when there were, very blue chip names doing these deals. But as, as the panelists would, and then you also know, it was really an evolution, because I think we were seeing high quality firms doing this in 2017 and 2018. Whether it was like Nordic Capital doing a very constructive fund restructuring, or BC Partners or Warburg Pincus doing an Asia strip sale. So I think, in many ways, the theme for private equity for the past 12 to 15 months has been COVID, and this environment has accelerated existing trends. I definitely think that applies to the GP-led secondary market.
Richard, on the buy side, where GP-led as well your main focus in the last few months?
They've clearly become so. I think we've clearly seen what Bernard mentioned in terms of capacity to process all of this. I don't think the team has been busier than in the last 6 months or 9 months almost, if you count since August. So that's certainly been a trend. And then I think the other part that also David mentioned in terms of GP quality and good GPs repeatedly also kind of using the technology, just because they get the concept and they appreciate the advantages that it has for them. That's something we've clearly seen a lot of. So GP-led has increasingly been important for us. It's something we like as well, given the quality is going up, just as David mentioned, and we have a strong primary heritage as a firm as well. So kind of GP quality is important for us. So we look very positively at these trends. I think they play to our strengths at the moment.
What do you think are the drivers of this GP-led boom? What is the driver for GPs now to explore such options?
I think in the end it's about, if you look at the single asset where it's kind of most obvious, it's just a very it's a winning element for everybody involved in this. So always assuming they run properly, but that's for people like Bernard to make sure. And I think on average that's clearly been the case. But it's really providing optionality to your LP. So kind of almost thinking of it like a client service, if you would think of it outside the financial industry. So it's an additional service to your LPs. It's an ability to continue with the management team, with the established kind of successful model that you've been running. So it's clearly a winning element for the GP, and obviously kind of riding the success of what they've been doing. So I think the motives for the GP are very strong. The motives towards their clients, the existing LPs, should be strong if you provide a clean optionality for them. And for us as a buyer, I mean, we're biased in liking it anyhow. So I think the overall concept makes a lot of sense. And on the more diversified, if you look at continuation vehicles, kind of year 10, 12, and all these things, is something that, for example, if we look at our older portfolios, kind of it tends to take longer than 10 years for a private equity fund to wind down. We all know that. So providing a solution to that is clearly appreciated from our side as well.
Yeah, Bernard,
primary investor.
Yeah, Bernard, what's your opinion on that? Why are GPs increasingly interested in these transactions?
Well, I think it provides them with one more exit option, especially if you look at single asset deals. Historically, GPs had 3 exit options, sell to a trade sale, or sell to a strategic, sell to another sponsor, or, maybe if the company and the conditions permit, do an IPO. Now they have the perfect solution, which is to sell to themselves. And on the way, extend the capture of the fee pool, in a sense that they get management fees for another 4 or 5 years. They can crystallize part of the carry on, especially if you look at in the US, where you have a different carry model than in Europe. I think they can crystallize carry. Obviously, usually they have to reinvest a sizable part of that. Usually around 70 to 75% is what we see, and then ultimately they can also have a new carry plan. So for a GP, it's a perfect solution. I think the one question mark is obviously whether existing LPs always get the best value. I think that's ultimately up to the GP and his advisors to make sure. I think what we see is that sometimes these processes are started because, for example, a traditional M&A process failed, or an IPO failed, and the GP is looking for an alternative. But also sometimes there are situations where maybe a traditional M&A sale process could work, but the GP is not so keen to explore it because they prefer obviously to keep the asset and capture the management fees. So I think there will probably be more pressure over time, especially from large investors like David, to make sure that perhaps, especially on larger deals, the GPs are forced to pursue a dual track process, whereby they maybe explore regular sale to another sponsor or to a strategic buyer, and while at the same time exploring the a continuation vehicle solution.
David, as an LP, how do you see this?
Yeah, no, I think there's a lot of complexity and nuance from what Bernard just said, and we see it in our portfolio. Like, we've seen managers who have explored like a full good faith sell side process where they've gone out to strategics and sponsors, but they didn't achieve the value they wanted, right? And then they came back to the LPAC and proposed a GP-led, because they said, look, we have 5 or 6 add-on acquisitions, and we know the management team, we've owned the asset for 5 or 6 years, we can increase the money multiple through this transaction, and come back to the market in 5 or 6 years to these buyers once we've really scaled the platform. Like that, as an LP, I'm really comfortable hearing, right? And there are two elements I want to hit on. There's the, like, what is the motivation of the GP? There are definitely GP-led transactions where, you know, it's very natural that the sponsor, they own the asset, they're the control investor, they know the management team, they've been executing on a value creation plan for, you know, 3, 4, 5, 6 years. And it makes a ton of sense for them, like, and it's very rational for them to say, let's keep some of the economics in-house and offer a liquidity option to the LPs. But the key thing to remember, and I think even myself and our side of the table as LPs, you know, it's not an exit. Like a GP-led isn't an exit. Like my view is that it's really, you know, it should be understood as a step in the value creation plan. It's the same sponsor owning the asset, continuing to control and manage the asset, right? It is not an exit. And so when you get the liquidity option, right? You know, let's bear in mind, you know, the capital is coming from secondary investors and dedicated secondary funds, right? It's not coming from another buyout shop. It's not a control deal. There's no control premium. And so what we as LPs have to evaluate is, okay, maybe the pricing, right, like is in, you know, what I sometimes refer to as this like seductive multiple range, right? Like maybe it's, you know, and this will sound too precise, but like, you know, 2.8 to 3.4 times gross multiple. You know, if you get a liquidity option like that, you know, as an LP, that's right in the strike zone and the target zone of private equity returns, right? So as a selling LP, I could take the liquidity and get 3x gross. That's not, you know, that's an interesting transaction. But I also need to understand, you know, the rolling LPs, the GP and the new secondary capital, right? There's money that may be left on the table if you believe in their ability to execute, you know, in the continuation vehicle. And then there will be an exit, right? So it's not really an exit. It's not, I think by definition, it's not a value maximizing transaction. It's an ability, you can provide liquidity along the path of value creation, right? And I think that's something that we as LPs have to bear in mind. And I do think, you know, Bernard referenced, I think one of the biggest risks on some GP-led deals where they have not run a process, and you know this is an alternative to a failed sell side. The risk is that your deal gets jumped, right? You work with you work with the secondary advisor, and you're structuring a GP-led transaction. If there's leakage in the market, you could be a strategic, or you could be a larger buyout fund, and they throw in an unsolicited offer. You know, then the sponsor gets sort of caught flat-footed because you have a fiduciary duty, right, to your fund and to your LPs, but you're also trying to lead this GP-led transaction. So I think there's an element of that in the market as well.
And what's your position typically? Are you like in the position to be forced to sell, or as a rolling LP, or even as a prospective buyer in this type of deals?
Yeah, I would say it's a mix. I mean, the challenge that we receive as LPs, and even Richard at his platform, they're also a primary investor, so I'm sure he's on the receiving end as well. None of these, there's like a GP-led market, it's not like the primary market where there's a kind of core LPA with standard terms. And when we make primary commitments, we're negotiating around 20% of it because a lot of the stuff is customary and well accepted in the market. Every GP-led deal is different. And, if I, maybe it's early in the morning and I haven't had my second cup of coffee, I'm a little cranky, but, as an LP, I would say the challenge is we have a full workload of primary fund commitments, monitoring the portfolio, internal strategic initiatives. And if we get a liquidity option falling into our inbox, every 3 or 4 weeks, that's like a 100-hour homework assignment, right?
Yeah.
And that's a challenge. I think that's a challenge that LPs face, especially if you have a fairly diversified portfolio and a number of manager relationships, it's a lot of work to get granular, and you have to really evaluate each deal on its own, because all the governance is different. And this is where I will also point out, I think in my 5 years in New York City, I've only seen, and then other team members have worked on other liquidity options, but in my personal experience, I've only seen one where there was something that was close to a true status quo option, where we could do, we could choose not to sell, we could choose not to roll in the new vehicle, which had new economics and new governance. And there was like a separate entity, or SPV, where you could be a status quo. And this is what LPs need to have. And I think it's becoming, like a unicorn in the GP-led market. We negotiated and we committed capital on a set of terms and economics. Why should that change for this transaction? And I've only seen that once, and I think it's becoming rare and rare. And the frustrating thing is, we're getting options where it's called a status quo option. And there was one deal last year, in 2020, where the status quo option had disclosure in the documents of about 20 pages of how the LPA and the SPV is materially different from the normal LPA. So how's that a status quo option, right? And even if you discount it for lawyers being cautious and you say 27 pages, maybe it's 10 pages of material differences, that's still not a status quo option.
That's right.
And maybe, I don't know if Richard has a point of view on that, because I'm sure he's seeing similar deal flow.
Of course, I mean, we can all guess our way around what you're referring to, but indeed, I mean, despite the fact that some of the legal changes, I mean, the first, at least in most cases, kind of at least the underlying stay the same. But I think there's, when we look at, I clearly take your see your point of the increased workload, and we naturally have the advantage that in most deals, given our secondary activity, very much play the relationship of our existing portfolio. Kind of we look at everything from both the selling and the buying side. So we've got some kind of just workload synergies, which is obviously convenient for us, but that's certainly something that if I think about an organization that doesn't kind of play the secondary buy side, it's new and it can be a lot. But on the other side, I think if part of and that depends, obviously you'd see some of the larger deals that we don't see, but those that we see mainly, if you can make the argument that it's structurally something needs to happen. So say continuation vehicle in year 10, I see the point that it's never a perfect role, because even as soon as you introduce fresh capital, it's not a perfect clean role anymore. I clearly see that. But then a lot of the motivations of doing the transaction is that kind of the old system doesn't work on a kind of keep going basis. So nothing's perfect, but in some things are just unavoidable if we need to solve for a situation that just doesn't allow for a keep going as a starter. So the role certainly, and would hope that most of what we're involved is as close to a fair role that it could, but we've certainly seen people stretch the definition of what a status quo option actually means.
I'd like, if you can, to move to the how the market is structuring. Bernard, you mentioned some firms now entering the market. Richard, you probably illustrate also the dynamics of this market. How do you see the buy side? Where do you see the buy side going? How does it structure? Can you comment on these new firms now entering the market and the competition that now rises?
Yeah, perhaps I can start with this one. I mean, I think what we have observed already for a few years is a trend to greater specialization among buyers, and I think the secondary fund who does everything and has a single product is probably going to be part of the marketplace, but I would say probably lose in relevance, because I think what we're seeing is that on the larger end, you're clearly seeing that some players are starting to offer different products to different LPs. For example, Strategic Partners is now raising a new fund. They will have a main fund that's think at about 12 or 13 billion. And then in addition to that, they're also raising what you could call a sidecar vehicle, which will be focused on more concentrated GP-leds, which will be about 2 or 3 billion. And I think the thinking behind that is that obviously, some LPs who invest in secondaries want to have a broadly diversified portfolio. They're happy with maybe a single high digit or low teens net return. On the other hand, there are other people who prefer more concentrated deals, which obviously have a higher multiple, but also higher risk, and will probably be in the mid-teens to maybe a bit higher in terms of net return. So I think we see a trend towards that. We see a trend towards people raising separate pools of capital for specific strategies. Like for example, on the credit side, we have seen a number of secondary funds who have raised a dedicated capital, to essentially be able to underwrite, credit secondaries. Essentially, if you look at, senior loans and direct lending funds, where you cannot essentially underwrite these deals with a, mid-teens return target, because then no one will transact. So you need to have a different capital. The same has been happening. The same has been happening, in infrastructure and in other strategies. So I think we also see, some funds now focusing, for example, on buying fund of fund and secondary fund positions, or we see, others who are, thinking about, maybe moving into real estate, like Brookfield's. For example, who's hired a team to do secondaries. I think the broader theme is that there is greater specialization, and at the same time, you have a number of new entrants. I think large asset managers, whether it's BlackRock, Apollo, obviously Carlyle, entered the secondary space a few years ago with the acquisition of AlpInvest. So I think we will see more of these large, multi-product GPs, play an important role, and especially on the GP-led side, because their DNA is in diligencing, companies, and so I think they can underwrite, single assets, and that's where the strength lies, and so that's a natural evolution of their business.
David, how do you see this asset class evolving from an LP point of view as an investor?
Yeah, look, I'm very bullish on secondaries, whether it's traditional LP portfolios and GP-leds, and at a high level, I think it's really, for me, it's because it's two examples on the LP side and now the GP side, where the market has continued to innovate to find solutions, like for either liquidity for LPs in an illiquid asset class, or liquidity for GPs, or solving for the duration mismatch of crown jewel assets that should be owned by a sponsor longer, but there's a mismatch with the 10+1+1 fund structure that our industry can't let go of for some reason. And you look at the volume growth, I think it's a really interesting part of the market. What I also think is interesting on one of the things Bernard said is all of the new entrants on the GP-led side. When we look at, and we're an LP in one of the dedicated GP-led secondaries funds, so that's how we have some insight into the market evolution. When you look at the deals that have been done, right, especially now in 2020, where you saw a number of large transactions in like the software or tech-enabled space, you need some fairly sizable equity checks. And all of the deals have been syndicates, right? And I think that's where it was referenced earlier. There is sort of like the amount of dedicated capital is catching up to the volume and the opportunity. I think the challenge will be if some of the large traditional control buyout multi-strategy firms, are entering, is there a channel conflict, right? I think it's different with, like say strategic partners, where they're part of Blackstone, but they've been part of strategic partners, and that had been part of Credit Suisse before, and they had a team and a brand in the market. It'll be interesting, like if and maybe Bernard has a point of view on this, on some of the transactions he's advised on. Is there sort of like a channel conflict if you're a direct buyout fund launching a GP-led strategy, and one of your direct competitors has a crown jewel asset that they want to drop into a continuation fund and do a deal, like, could there be a channel conflict, or how can you win those deals? But I think, maybe the market will find a way to evolve in that respect as well.
Yeah, I think there is obviously a potential potential conflict there, but I think when you talk to some of these large controlled buyout firms, they say, well, look, we have done club deals with other firms before, so that's this conflict can be managed. And also I think from their perspective, they if they are not playing in this market, they will not have access to these assets, and so it's a bit I think to have a shot at also holding these assets, the only way for them is really to be a player in this market, because if they just remain in the traditional control investment market, I mean a lot of these assets will probably not show up for a while. And so I think they can offer their investors an access route to get some exposure to some of these high performing assets, which I think is attractive.
Perhaps before we move to the questions in the audience, I understand there are a couple of them. Richard, I'd be also interested to hear you about this evolution on the buy side landscape.
In terms of the different sub assets, I think it's been bound to come. I mean, when we started kind of our secondary efforts here, we started on the credit with a couple of credit deals, and we used to underwrite into equity returns, so that was great. But we clearly, Bernard will know, we clearly can't anymore. So I mean, it was bound to come as the industry evolves, and the way we solve this is we have the different strategy. We have fund of funds for infrastructure, we have fund of funds for credit, and if we do deals in those secondary deals in those asset classes, then we do them for those fund of funds, because you clearly have to put the right fund of capital in those assets nowadays.
And how is it in the market or smaller mid market that you're mostly involved in?
It's the same. I mean, we feel, and that's why we feel comfortable on the smaller end, that the pressure is the price pressure is lesser than on the upper end. But that doesn't mean that the relative trend doesn't play into that smaller segment as well.